Welcome to the Commercial Real Estate Show, your source for insightful analysis and enlightening discussions. Hello, I'm Michael Bull. Thanks for being with us on one of the 40 radio stations, iTunes, YouTube, or the show website, CREshow.com. Today our show is called Show Me the Money, right? We're always looking for money, right? So today we'll talk about the latest sources, the rates, terms, and underwriting standards for various types of properties, borrowers, and price ranges. We'll share some best practices, we'll share some market intelligence, and some resources to power your funding requirements. Please welcome my first guest, is Steve Renna. He's President and CEO of CRE Finance Council. Steve, thanks for joining us today.
Michael, thanks for having me here. It's a pleasure.
Well, we appreciate that. And first of all, tell us briefly about the CRE Finance Council.
Sure. We are the global trade association for the commercial real estate finance industry. Our members are comprised of lenders of all different types, whether they're balance sheet lenders, banks, life insurance companies, whether they are securitized lenders, so the CMBS lenders, or whether they're specialty lenders and have private capital sources that like private equity funds. In addition to that, our members include the investors in CMBS bonds, commercial mortgage-backed securities bonds, as well as investors that are investing in different types of loan portfolios. And in addition to that, we have a broad array of the servicing community, your standard mortgage servicing companies, master servicers, special servicers, and all different types of companies, law firms, accounting firms, analytical firms that support the industry overall. We have 280 member companies in the United States. We are also global. We have an affiliate in Europe as well as Japan.
Okay, excellent. And let's talk about the CMBS world. You know, there's been a lot of talk of the maturities going to be coming up in this year and the next year, and that some of these properties may have been bought at the height of the market. What do you guys see happening there? Is there enough money to fund these deals? Are the values back strong enough? Are we going to have any challenges?
Right, Michael, that's a really good question. And just by way of background for your listeners, 2005 through 2007 was the peak of issuance by CMBS lenders. And also it was at the time when the values of properties were at their highest. After the liquidity crisis, the CMBS industry virtually disappeared. And there were questions for a couple of years as to whether the industry was going to come back as a product type. It has. Fortunately, over the last couple of years, it's grown at a very steady pace. From 3 years ago, we were at about $45 billion a year. And then the year after that, about $85 billion. And now we're over $90 billion a year in 2014. The forecast for 2015 is to be about $110 billion a year. To put it a little bit in perspective, at our peak in 2007, we were at $230 billion of issuance, which was obviously a very frothy time. But when you look at it, you have 2005 through 2007 where you have significant amount of CMBS maturities that come due 10 years later because they're 10-year terms on the CMBS. So in 2015, we're facing $100 billion of CMBS maturities, so loans that have to be refinanced that were financed at a time when property values were at their frothiest. 2016, we're looking at another $110 billion. And in 2017, $137 billion. So this is a significant amount, and the concern that people in the industry have had over the most recent years is when these maturities start rolling and coming due, will there be enough financing capacity in CMBS to be able to handle those maturities? Certainly, in some cases, there are going to be loans that values just simply have not come back far enough to get refinanced in full, and there's going to have to be some working out of them. But I think to answer the question so far that people in the industry have had about whether we're going to be able to meet this maturity wave, the answer so far is yes. There's ample capital in the marketplace because of interest rates are low, and also the relative value of real estate is strong. So there is plenty of capital that's into the CMBS, put into the CMBS industry. We have over 41 conduit lenders right now, so they feel that there's a number of conduit lenders believe that there are opportunities in the marketplace to refinance this. And of course, the economy has improved Values have improved in assets, so they've come back. Borrowers, because of low borrowing costs generally, have been able to develop reserves that they could put into properties if there's some borrower equity that needs to be infused in order to get a refinancing. So overall, we are in pretty good shape so far at the start of 2015 to meet the maturity requirements.
Okay, and Steve, these loans that you mentioned for the 3 years, or what about $300 billion or so? What are the state of these CMBS loans now? Are some of these loans in trouble, or are these all? What percentage of them is current?
I don't quite know what the percentage is for each year, but certainly some of them are in trouble. And what's happening too, that's an opportunity, but it's a bit of a concern, is that there's a high rate of defeasance that's going on right now. Defeasance basically means that you're able to prepay a loan before it comes mature, as long as you substitute for that loan U.S. Treasuries as collateral. So borrowers are looking at the opportunity to refinance properties now that are going to be maturing in the next year, 2 or 3 years. And that is taking the better quality loans out of the pool, because those that are able to defease are ones that obviously have stronger values. And it is leaving a little bit of the weaker loans in the pool. You have a bit of adverse selection. So there is going to be a concern that you might have a bit of a higher concentration in the pools of loans that are going to have more trouble getting worked out. I think what I would say, though, is if a loan doesn't get refinanced and has to get worked out, the distressed community, I know this is something you and I have just talked about discussing as well on our call. In the distressed community, we've had a lot of experience recently in working out distressed loans, understanding what it takes to do that, finding the capital sources that are necessary in order to acquire the loans and then reposition them. So I think I guess to sum it up, I would say if the industry isn't in position to refinance a loan, if the loan isn't refinanceable, I think the ability to work the loan out is also pretty good at this point.
Yeah, I guess we've all gotten pretty good at that, right, over the last several years of dealing with these distressed loans. Well,
the school hard knocks, right?
Right. What about opportunities? There's plenty of investors out there that would like to get into some distress opportunities. So there might be some opportunities for them.
It is the chase for yield right now, and the wide yields that investors were accustomed to getting back when, if you had capital and there were a lot of loans that needed refinancing and you were one of the rare capital sources, you were in good position to get high yields. But right now, because of the amount of capital that's in the market, it makes it much more challenging to get yield. So, but there are still opportunities for those that are trying to work out in the distressed side. If you have capital that's available and you have the know-how and how to work an asset out and you can move quickly, you have opportunities. I think the thing that people at that side of the sector have to keep in mind, though, is that the banks have substantially worked out their distressed pools and sold them off and got them off their balance sheet. So a lot of the distress that has existed in the market has been worked through. So there's not a lot of it right now. I think there will be more in 15, 16, and 17 as we do get those CMBS loans that come due for maturity that aren't going to be refinanceable.
Yeah, I think you're right. And I think we've run through a lot of our REO properties with a lot of our clients and funds and things. And and I think, too, the values over the next 2 or 3 years looks like they may improve. So there may not be the opportunities for the distressed buyers. And hopefully there is plenty of money available. Like you said, a lot of lenders and investors chasing yield. So what are your concerns about the finance market? We have to take a break here in a minute, but quickly, what are some concerns?
Well, the concern is it's a highly competitive finance market right now. You have many lenders. You have a lot of investment capital flooding into commercial real estate. I think some of the reasons for that, it's just a good relative value relative to corporate bonds. When we've gone, as we have in the last 5 years, through a terrible economic crisis and a liquidity crisis, investors are looking to invest in assets they can see and feel, and real estate is one of them, obviously. So it's a very attractive investment, as I said, has good relative value. The downside of that is that you get so much capital coming into the market, it becomes very highly competitive, and so lenders, in order to compete, have to stretch perhaps their underwriting standards and also maybe stretch a little bit on the amount of proceeds or the rate that they're charging. So you get loans that are made that may lack all the discipline that you would want in a particular loan, and so you may be sowing seeds for the future for future distress if you get too frothy in the lending that you're doing.
All right, and I think our lenders like to know, our listeners, borrowers and lenders like to know more about that. So we'll be right back more with Steve Renna. I'm Michael Bull. This is the Commercial Real Estate Show. We'll be right back. The Commercial Real Estate Show is brought to you in part by RealNex, providing a comprehensive suite of powerful commercial real estate tools at an incredibly low cost. Visit realnex.com. That's REALNEX. Welcome back to the Commercial Real Estate Show. I'm Michael Bull. Today our show is called Show Me the Money. My guest is Steve Renna. He is CEO and president of CRE Finance Council. And Steve, we were talking before the break about underwriting, and I think a lot of borrowers would think the underwriting is still pretty stringent. But I guess you're talking to the lender side a lot. What's going on with underwriting right now?
Well, as we were talking about in the first segment, credit is clearly deteriorating. I think it's a function of competition in the marketplace among lenders, but also the fact that, after the financial crisis, the underwriting standards were ultra conservative, and we're moving away from those. And to give you a couple frame of reference points, property supply right now, so new supply coming into the market of different assets, is below 4%, which is very low. And most of that is in the multifamily sector. So you still have a very constrained property supply. Loan originations right now are still down 53% below the 2007 peak. And loan-to-value ratio is kind of another metric. It was at about 71% on average in 2007, and in end of 2014 it was at 66%. So yes, there is some deterioration of loans, and borrowers are probably still thinking there's some stringent provisions that are being applied to them. But for the most part, credit is loosening, and that is a bit of a concern for the industry, because you don't want to, as I said earlier, be kind of sowing the seeds of problems in the future. But on a relative basis, we're nowhere near where we were in 2007.
Right. And let's talk about new supply for a moment. I think that's one of the things that have really helped the commercial real estate world, right, is the lack of new supply has really helped the fundamentals. What about financing for new supply? It seemed like a few years ago that financing for a new project was very difficult. Where are we now?
Sure. Financing for new projects, typically you had your traditional lending sources being banks and life insurance companies, or the CMBS industry, or the agencies, meaning the Fannie Mae or Freddie Mac. But now you're seeing a growth in private equity generally. So non-bank lenders are coming into the marketplace more and more. These are your classic private equity firms on one hand, finding that real estate, which 5, 6, 7 years ago was sort of a pedestrian asset for them, is now an asset they very much want to embrace in their portfolios, both from an equity side and from a debt side. So we have growth in the industry from a lending source in the private equity side of the equation. In addition to that, you have two new alternative financing sources that are really becoming quite the rage right now. One is called EB-5 financing, and this is a government program actually designed to raise money by providing visas. So the government says to a foreign investor, you can get a visa to have a green card in the United States if you provide $500,000 of investment in the United States that produces a certain number of jobs that's on a particular scale. And it turns out that this program is very well suited towards construction financing for real estate, because when they're doing the calculation of the jobs that have to be created, temporary construction jobs, as well as any permanent jobs that exist as a result of real estate construction, count in that calculation. So there has been a tremendous amount of money coming in through this EB-5 program. About 85% of it actually is coming from China, that is funding development projects right now. There's about $4 billion of EB-5 financing expected to come into the United States in 2015. And it's something that's being used by developers across the country, but some of them are the most significant developers that we have going on, there are in the country with some of the most significant projects. For example, related companies using probably $600 million of EB-5 financing for the well-known Hudson Yards development project in New York City. Lennar, Durst, Ratner, all major development companies are using this EB-5 financing. So it's a new alternative form of financing that's very low cost for developers, and it's working out very successfully.
And where would our listeners obtain the source for this EB-5 money? Where can they find it?
You know, it's a complicated project. What I would suggest you do, a lot of law firms are very good at navigating clients through the EB-5 process. It's something that requires someone to be a student of, to understand how it works. There are many aspects of it and levels, and you need to know what you're doing. But I would say start with a law firm that you're using to find out more about EB-5 financing. They're all on top of it.
Okay, excellent. And let's talk about another source for funding that we're hearing a lot about, and that's crowdfunding.
Yes, crowdfunding, quite a phenomenon. Basically, you know, using the internet to be able to reach smaller investors, lower income relative to high income investors that have only had access to commercial real estate finance projects through kind of privately placed deals. But crowdfunding, basically through the internet, you have these platforms that have been established to be able to solicit kind of your average investor into real estate projects with small unit prices for the amount of the investment. Now, the crowdfunding initially, when it was set up, was kind of designed. People looked at it saying, "Hey, if you want to invest in your community in a redevelopment project, maybe you know, on Main Street, you know, crowdfunding can help put together the money for that, and we'll get you know, units of contributions from different people, and we'll be able to finance something that's in your hometown." It's really mushroomed beyond that considerably. Because of the ability to raise fairly significant sums of money quite quickly through the internet, you have larger real estate companies that are looking for, you know, supplemental financing as they're doing their capital raises or the financing raises, and going to the crowdfunding platforms and using them to provide that source of financing. So you have your traditional lenders providing X amount, maybe you'll have a second loan providing another amount, and crowdfunding can come in and provide yet an additional amount of financing at a fairly low cost as well. So it's very efficient, very low cost, and it's something that the real estate finance industry is taking a very hard look at, and you have a number of companies within our association that are using crowdfunding and believing that it's going to be a significant way of the future for financing.
Wow, that's interesting to hear from the CRE Finance Council, and it's also interesting when you think about retail investors. If they're investing through crowdfunding on the equity side, you know, they may be there may be returns there that will adjust. But if you think if they're financing in the financing, if they're investing in the financing part, maybe they've got a first-party deed to secure debt, right? Maybe they have a set 6% return that they can feel comfortable with, right?
Right, and retail investors, you know, often aren't comfortable taking a lot of risk. So if you know you have equity in front of you, that could be a good place for you to be.
Yeah. Well, let's talk quickly about the federal policies that are affecting commercial real estate financing.
Yeah, you know, right now Congress is in a mode where there isn't a lot getting done, and they probably like it that way. There might be steps in the legislative process where you may see issues like some reform to Dodd-Frank. I know that is something that the Senate Banking Committee and the House Financial Services Committee are looking at, but I think that's going to be a fairly slow process and probably one difficult to get along over the finish line. And you always have discussions of GSE reform, but again, I just don't think there's really a lot of will to come to an agreement at this point. Although if Fannie and Freddie, which have had in 2014 did not have good years, and they, from a income standpoint, if they start having to draw on their lines of credit from Treasury, since they are in conservatorship, to be able to function, that could reignite a little more the GSE reform talk. But for the most part, on those two fronts, probably not a lot of movement going on. But where there is a lot of movement is Dodd-Frank sparked a lot of regulatory initiatives that affect the banking industry generally, and then within that, commercial real estate finance. So you have a myriad of regulations that are going to be coming due between now and 2019 in different implementation phases. So some of those are risk retention, under Dodd-Frank. You have the Volcker Rule, also under Dodd-Frank. You have the Basel rules, which are the capital reserve requirement rules for banks. All these are under revision, plus other more ancillary types of regulations. The bottom line of this all, Michael, is that all these rules collectively are going to require the banks to reserve more capital behind the commercial real estate loans that they make. And it's like that adage with respect to taxation. If you want less of something, tax it, and you're going to get less of it. Requiring more capital reserves on banks in the name of bank safety in order to make commercial real estate finance loans, you're going to get less of it. And what you have out there is going to become more expensive. So that's the situation that we're dealing with right now, and we're undertaking a campaign to educate lawmakers as to the collective sort of holistic impact of banking regulations on commercial real estate finance. And I think the last thing I'll say with respect to that is like, well, those are the big banks, it's the big top 20 money center banks that are being regulated for the most part. We say, yes, they are, but they also really are the main source of liquidity in our market. So, for example, the non-shadow banking industry needs lines of credits from these banks in order to function. So whatever happens to the main banks is going to trickle down through to regional banks, community banks, and it's also going to affect other forms of financing, such as the shadow banking industry.
Yeah, well said. Well, Steve, thanks for joining us today. We appreciate you being on the show.
My pleasure, Michael. Thank you very much.
Well, stay tuned. We'll have more on Show Me the Money. I'm Michael Bull. This is the Commercial Real Estate Show. We'll be right back. The Commercial Real Estate Show is brought to you by Bull Realty Commercial Advisors, a great place to do business. Visit bullrealty.com. RealNex, a comprehensive and powerful suite of commercial real estate tools at an incredibly low price. Visit realnex.com. That's REALNEX. FIU, Florida International University. Earn your master's in real estate in as little as 10 months without interrupting your career. Visit FIUonline.com. Xceligent, the resource professionals use for commercial real estate information. Visit xceligent.com. That's XCELIGENT. Commercial Search, the source to market and source available properties for sale or lease. Visit commercialsearch.com. For more information on these great companies or for additional videos, podcasts, or articles, visit CREshow.com.